Welcome back to Good Returns. I'm Matt here with Garrett, and we are working remote this week, so bear with us on the setup, but the content is worth it. We had a lot of very interesting things and things that matter to your retirement plan and to your portfolio, so let's get into it. And I'm in a swivel chair, and so I'm going to try to not do this, which is going to be hard.
Yeah, I
It's
also
gonna
am
be
in
very
a swivel
difficult to
chair. I
do.
can match your swivels.
Yeah.
Yeah, a lot happened. Inflation came in hot. And yields, bond yields kind of are taking off. And today we have Jerome Powell is his last day today. So should have had some poppers or something, some confetti. Jerome Powell will say goodbye to the chairmanship today. He will stay on the board. But yeah, today's the last day. Kevin Warsh was confirmed. We'll talk about that in a minute.
Yeah, I mean, we have 12 years at the Fed, 8 as chair. We'll get into that. Quick note, of course, everything on this podcast is for educational purposes only, not to be taken as individual, personalized financial advice. So think of this as context information to get you thinking, to get you to be able to ask questions that you may not know you need to ask. And you can always reach out to a trusted advisor. Feel free to go to momentumwealth.us, and we'll be more than happy to speak with you about your specific situation.
Yeah, so let's hop into it. We got so this will mark 7 weeks of consecutive gains. The S&P and NASDAQ both at all-time highs. Again, we keep talking about that every week. More than 2% up for the week. Small caps and equal weight S&P posted modest gains. So the narrowness that we've been talking about is still there. Technology-led energy was the second best sector this week as oil sort of re-escalated middle of the week, toward the middle of the week.
Yeah, fixed income bonds had a tough week. Treasury yields rose. Really, it was across the curve. So the yield curve itself wasn't necessarily affected. You did have the 30-year go above 5. That's the first time in a while. Corporate bonds held up better as credit spreads tightened. And we talked about credit spreads about 2 weeks ago and the importance of those. And not a shocker, international underperformed U.S. equities.
Yeah, that's been a story that's kind of been a similar theme over the past few weeks. We had really strong outperformance of it for a little while, and then not so much. Now that's talking strictly about international. Emerging markets we still have in a really good spot, actually. But the defining story of the week wasn't really even the stock market. It was inflation. And that's where we're kind of going to spend most time today. It's going to be sort of a truncated episode because we are remote, but yeah, let's dive into the inflation story.
Yeah, so there's two sides of the inflation story, and the understanding of this is really going to help transition into the planning room as we talk about the impact on your portfolio, not just today, but 10 and 20 years from now. So the inflation print that came out is really split between two parts. One is the CPI, the Consumer Price Index, and the other is the core PCE, the Consumer Price Index, stripping out the volatility aspects, the more volatile aspects of it, such as food and energy. So if you look at the headline print, which the Fed actually does not pay attention to, that did print hot because of increases in oil prices, mainly 3.8% year over year. Now, if you look at the core, which is what the Fed in part likes to look at, is between the core PCE and then the core CPI, was actually flat year over year. It was the exact same rate that it was basically a year ago. But the headline number definitely was the highest reading in 36 months. The wholesale number was a bigger surprise, though. So this is what's interesting. The producer price index came in 6% year over year, which is a big annual gain. In fact, it is a large annual gain. So I mean, the wholesale really, the headline CPI, not surprising. When you strip out food and energy, it's essentially a rate that we had basically 12 months ago. And so that stripping out of that volatile food and energy, the trend is still intact. That started back in late 2023. But yeah, let's talk about that wholesale number because that was interesting.
Yeah, 6% increase in the producer products is quite significant. Wholesale prices are essentially businesses' costs, the cost that businesses pay for the goods before they get passed to consumers. And so when it runs hot like that, it could potentially signal that more consumer inflation is coming. It's sort of like a pipeline for it. Again, it doesn't always happen that way, but it's a possibility. It's something that we have to acknowledge.
Yeah, and it goes back to, and I don't know, as time passes throughout this year, you may see more talk of whether or not the 2% target is relevant or the 2.5% target is relevant or a 3% target is relevant as far as what the Fed considers to be stable monetary policy. But at the end of the day, gas being at what it is is driving a lot of what we're seeing. And so you got to think, okay, well, if gas taxes, state or federal, get suspended, does that basically is it a rug pull for next month's CPI print or 2 months after CPI print? So there's a lot of noise. It really is a lot of noise. I think the wholesale was very interesting. The headline CPI wasn't very um, surprising, I guess, so to speak. But I mean,
Well,
it
I think
wasn't
here's
just energy. There was some other categories,
yep.
right? That
Yeah, it's services, but it is energy. I mean, because that those all feed into it. Energy feeds into the services category, which was, kind of deserves a lot of attention here. We're looking at airfare, hotels, rent, all of that also rose, and it's because energy inflation bleeds into everything, and so it's sort of like it's not an energy story, but at the same time, it is an energy story because it's feeding into that. So we're starting to see that again. Is it going to be anything bigger than that? We'll just have to keep watching it. But
yeah,
it
I
is
mean, and you
a
have
possibility.
yeah, it's definitely have to be honest about the possibility. But we hold the view, and anybody that's listening, and if you've thought about upping your contributions to your 401k or starting your contributions to your 401k, you know intuitively, if those thoughts have already entered your mind, you already know intuitively that is the action you must take if you want to grow any type of wealth. If you want to compound, if you want to beat out inflation, if you want to actually save something that's going to have purchasing power in the future, you have to go into the market. You can't just hold dollars. Dollars go down in value. We know this. But that journey, let's say over a 10 or 20-year time frame of either building up your account balance or beginning to take income from it, you know that you're going to have months where the market's down. You may even have a year where the market's flat or the market's down. You're going to have things that move in the direction that is opposite of that which you want. But you do know, beyond a shadow of a doubt, 20 years from now, the market is going to be worth more then than it is now. Just like your home is going to be worth more in 20 years than it is now. Just like your anything of value, anything that represents income, dividends, economic growth, an expanding business or rarity, such as some commodities, such as collectibles, you know they're going to be worth more if for nothing else, the simple fact the dollar will be worth less. So you'll have time periods where the market's going to move against you. It's going to make you question things. And then a year from now, you're going to be like, oh, why was I worried? Right? I'm up 15% or I'm up 20%. Same thing with this recent upward trajectory of inflation driven by oil prices. The technological advancements that are taking place are really underpinning my perspective that inflation comes down. And it's that simple reality that inflation comes down is what's going to drive the debasement of the dollar uh, even stronger and even more money printing and even more monetary expansion in the future because the debt-based economies of the world cannot have deflation. It is not an option. You saw what the central bank did to rein in inflation. Imagine what they would do to stop deflation. It would be orders of magnitude greater of an action. And so that'll again, that reality that'll flow into the planning room. We'll talk about it in a second. But I still look at this oil falls, supply disruption gets resolved, inflation fades. That is most likely the reality that we're seeing. And I think that's still what we're seeing priced into the NASDAQ, the S&P, and the Dow. The Dow crossed 50,000 yesterday. So I think they're pricing that in, but that doesn't mean in the near term you're not going to have some significant movements in the market that could be driven by these headlines for sure.
Well, I think it also is worth having a conversation about the fact that it may not just be technology. That's one part of it, but the market we've talked about before tends to price in a lot of different outcomes. They price in the outcome. They don't necessarily price in how you get to the outcome. So to your point about technology kind of helping the cost of oil, the other thing that we're seeing and we could see more of is, UAE, we talked about it before, they left OPEC. And so as these countries start to leave and take care of their own production, what does that mean for the regime previously that we've lived under that is like, they're kind of putting a lid on the output. They're controlling all that stuff, and it directly relates to the price of oil, which directly relates to the price of gas. So when all these things start to the paradigms start to shift, what does that mean? I mean, I think you have to acknowledge that it means a potential lower cost in those commodities.
Yeah, it absolutely does. That's why 3 weeks ago I laid out and articulated exactly why oil didn't do what people thought it would do. When all this chaos started unfolding, you will not see oil at $200 a barrel. You will not see it at $300 a barrel. And if for nothing else, the simple fact that all of these oil-rich economies, which, I mean, the United States is now a net exporter of oil, and that we started to really, coming out of 2014, 2015, become a significant producer, and now that trend has just continued. All these oil-based economies are going to look and say, every dollar it goes up a barrel, they want to pump and extract more of it out of the ground. But they also understand that they're sitting on a melting ice cube, and that the Stone Age did not turn into the Bronze Age because they ran out of stones, right? Technological advancement lifted us from the Stone Age to the Bronze Age because of improvements, more efficiencies. And the oil-rich economies understand that. They understand that the dominance of fossil fuels has already peaked, and it is now on a downward trajectory, and they're sitting on a melting ice cube, and they want to do everything possible to extract as much of that out of the ground before it is worthless. And the UAE making that decision makes perfect sense. They're not going to be the last. There will be others that will do it, and they are going to pump enormous amounts of oil out of the ground. And I think that leads to it as well. Kind of whatever gets us there. I think that the smart money in the room is absolutely pricing in much cheaper oil and subsequently less impact to CPI and kind of the bleed through effect into the service sectors. Doesn't mean it's not going to be a bumpy ride, but if you're making retirement planning decisions or investment planning decisions based on the price of oil, things are going to look incredibly different 36 months from now. And if you plan to be around in 36 months, that's what you should be focusing on, not worrying about, oh, gee, Willie, eggs went up, 15 cents. I don't need to be in the stock market. You need to be understanding that the real threat to your portfolio is truly, in fact, inflation, but it's not in the way that you think it is. It's over a long period of time that you're going to have to fight the debasement of the currency that is, in fact, coming. But yeah, I mean, it's a great point. Great point. I think the UAE thing was really underreported for its significance. I mean, it's a big deal.
Yeah, I think
it's
it will
a giant
have
deal.
Big implications.
Yeah.
Either way, the direction of the inflation story depends almost entirely on whether the oil supply situation resolves. We're going to be continuing to watch that. We talk about it every week, it feels like, but it's sort of the thread that connects everything. If we pivot now, moving to Kevin Warsh, he was confirmed by the Senate this week in what ended up being a very close vote, actually. I think it was maybe one of the closest in modern history. But he takes over from Powell in June. And as we sit here today on Powell's last day, which we already talked about, it's worth acknowledging what a transition like that actually means.
Yeah, I've got a phone call. I got to congratulate Powell, wish him happy retirement later.
Well, he's not retiring yet.
And
maybe one day.
Yeah. Well, listen, he inherited a different regime from his predecessors at the Fed that had really had a step change in how active they were really in the bond markets. Um, went through COVID, navigated the fastest rate hiking cycle in decades, and as a percentage change, the highest uh, rate hike cycle in history, U.S. history. Inflation did come down. From that CPI print of 9%, came down with what I would say was a kind of a smoothed out rolling recession. Some people say it was a soft landing. There's no recession, but I think if you look at the the PMI index, those types of things, you see it definitely was recessionary. It felt recessionary, but it was more of a soft rolling recession. So reasonable people definitely can disagree about the different decisions the Fed made along the way, but he's got a record to hang his hat on for sure.
Yeah, so now we have Warsh inheriting another kind of sort of complicated situation, kind of. Economy is still growing. You've got the oil shock that pushed inflation potentially back up. A lot of dissenters in the Fed about whether they should cut, whether they should not do anything, whether they should raise. And then a market that is kind of pricing in currently the lack of any kind of movement for the rest of the year, certainly, is what, at least in the futures markets, is what it seems to be pointing
Yeah,
to.
I think we talked about that a month ago, and then it changed, and now it's changed back. We'll
Yep.
see.
It will.
Yeah.
It will continue to do that. That's why it's so hard to say. Like, you will read these news articles about market, rate cuts are off the table for 2026. It's hard to say that because you're only getting a snapshot of a moment in time. And to your point, it changes weekly. So one of the reasons we do this show is because it changes that frequently. So you can have one
Yeah.
week where you talk about how people are saying that rates should be hiked. The next week you're talking about rates should be flat. The next week you're talking about let's cut rates. So it's a hard thing to kind of gauge. But I think just the baseline, what we should probably expect, or what I'm expecting at least, the baseline for 2026 is that nothing really happens one way or the other. But we'll see what happens when Warsh gets in and starts making his case for his view on it.
Yeah, it's going to be interesting. I mean, we know his longer term view is that rates should be lower. AI productivity is deflationary. That thesis really hasn't changed, but he will walk into his first meeting with what is a hot print, and they got to figure out how to play that, how to keep confidence in the central bank up, and kind of hold those two competing views. And so, yeah, the market's wondering. They're trying to price in what's the next move, up or down, and it'll be interesting. It'll be interesting. It'll be interesting to watch for sure.
Yeah, we're going to watch the first press conference pretty closely, see about communication style changes. There's already been some, there's a guy at the Wall Street Journal we've talked about before, Nick Timmeros, I think is how you say his name, but he is sort of the Fed mouthpiece to sort of the news organizations. And he has already kind of alluded to the fact that there's going to be some communication style changes with the Federal Reserve and how they talk about things. And so we'll see if that is actually going to be a shift. We'll see kind of how the market's going to calibrate to that, but we'll just kind of keep an eye on it.
Yeah,
Let's
absolutely.
get into the market though.
Yeah, we're looking at 7 consecutive weeks of gains. We have had some new all-time highs. Market, the index level is not caring at all about that CPI print, as we've already kind of alluded to. But yeah, we've had some great earnings. Continued. We talked about that 2 weeks ago. Yep. Still seeing some continued positive trajectory on earnings.
Yeah, a big reason is also the consumer spending. April sales beat expectations, up 4.9% year over year. You strip out auto and fuel, that's still an increase month over month. $4.50 gas on average. That's a pretty resilient consumer, we could say. Now, is that going to hold up? That's a conversation for future podcasts, I guess.
Yeah, and I'm sure we'll delve into that here depending on how long this kind of stays in the headlines. For sure, I'm sure we'll end up delving into that and the strength of the consumer. Apple, very interesting developments with Apple, crossed 300 a share for the first time this week. So, what does that mean? That means that a lot of the index gains really came from a handful of mega mega cap tech moves that were centered around that summit in Beijing and some of the potential opening up of new markets to some of those large companies. NVIDIA, expansion of Tesla's business activities there, Apple, et cetera, et cetera. So that's really was a big driver as well. We can't really ignore what some of these large mega cap stocks have done this last week.
Yeah, really interesting about Apple in particular, because it's on the heels of an announcement of a change in CEO. So we got John Ternus taking over in September-ish, I think, from Tim Cook, who is the current CEO. I think a lot of people have sort of been down on Apple over the past, I would say, I mean, maybe a couple of years actually, because they're not keeping up with competition as far as AI is concerned, assistant, all that kind of stuff. They were one of the first to announce an assistant all those years ago when they released Siri, and it was cool that the phone could do such and such. It could talk to you, but now we're in a different regime, and they're not keeping pace. They're also said to be very unhappy with their partnership with OpenAI, so reconsidering all that. So if you have a company like Apple, who has had a leader, Tim Cook, that took over from the founder of the company, and now you're transitioning to a new leader and your stock price is reaching all-time highs, I think that's a pretty good sign. I mean, I think that's a good sign that Apple potentially in the future is going to be in good hands. I think they will. I like the Ternus pick. He's an established guy. He's been there for a long time. He's had his hand in hardware for a while. And, you know, to your point, we had a conversation about hardware versus software. I think they have the right formula here. And if they can solve that missing piece of the puzzle, I'm optimistic about it. And I don't think I would have said that 8 months ago.
Yeah, it's definitely a lot to watch, and with what I predict probably to be the last period for a while of CPI driving the headlines. I really do. You can kind of hold me to that. I think this summer will probably be the last for a long time. That's what drives the headlines. Um, we need to talk a little bit about how you really go about inflation proofing your retirement income as we transition into the planning room. So
Yeah, let's talk about that.
welcome in,
Yeah,
welcome
welcome
in,
to the planning
welcome
room. We're
in
here at
to
the
the
planning room
planning
now.
room. We're going to keep it tight. I'm going to try not to go down any rabbit trails, but I do want to elaborate a little bit because the topic is very important, especially now that, again, that CPI print probably, you know, you think back for biggest move in 36 months. So it's kind of front and center of everybody's mind. And there are versions of retirement planning that works great at 2%. And then there's versions of retirement planning that may need to be taken into account if inflation would in fact stay higher. And what's interesting is because I hold the view that necessarily inflation, and especially as Trueflation's reporting it, and it seems to back up my thesis as well, will continue to trend down because of the productivity, because of similar views that Kevin Warsh has. And the reason is because technological advancement, when you study it, is the most powerful deflationary force in human history. And there's something called Moore's Law, which is where technological advancement generally doubles every 18 months, which it becomes cheaper and more productive. And it puts downward pressures on the central bank. That downward price pressure is something that fiat systems, you know, cannot live with. A structural deflationary trend, it poses what you would call an existential threat to the central banking system, to the global fiat system, because the fiat system requires continuous inflation. Think our 2% target, which everyone needs to keep in mind. The Fed's talked about fighting inflation. They're not going to get rid of it. They just want it to be at their 2% target, which over 10 years, if you have $1 million buried under the mattress, in 10 years, it's now worth 800,000. That's what 2% a year gets you. Over 20 years, it's worth 600,000. So they're just guaranteeing debasement at 2%, but they're not saying they want to get rid of it because the fiat model requires continuous inflation and credit expansion in order to service the massive compounding debt burdens around the world. And so whether it's 2%, whether it's 4%, what we need to understand is that the AI boom that is occurring is going to increase productivity in ways that's hard to comprehend. It takes that 18-month cycle, and the Moore's law is really outdated, because right now just the hardware efficiency alone is doubling every 6 months. The algorithm efficiency is improving. I guess what essentially would be doubling every 3.5 to 4 months. And we're even seeing the token cost between, like, say, Grok, Anthropic, ChatGPT, because of the competitive nature and all of these improvements. Sometimes those API tokens will go down by 90% from one day to the next. So all of that means that no matter how comfortable you get, when the headlines disappear and everybody forgets about inflation because now it's at 1.9 or it's at 2.2 and people don't talk about it anymore, you need to understand that the Federal Reserve and the central banks around the world will do what is ever necessary to keep that inflation number positive, which means they are going to print money, they're going to expand the money supply, and it's going to make your dollars worth less, guaranteed over time. So even though you're probably, and I just predicted, the headline information about inflation is going to disappear very soon. And once that happens, every time you see a headline about artificial intelligence taking someone's job or increasing productivity, that needs to put right into your mind. You need to make sure your investment plan is growth oriented. You need to make sure your retirement plan is understanding that the value of money 20 years from now is not going to be the value of money today, because the deflation is a much greater threat to the system, and they will do whatever it takes. We saw that during COVID. They will do literally whatever it takes, and not short of dumping money out of helicopters or C-130s if necessary. So just wanted to put that out there, because again, I think that once oil drops, it'll start fading away, the headlines, and it'll probably, that concern may not be in the front of people's minds, but it needs to be, because it's insidious. Even at a 2% number, it is insidious.
Well, I think when you get into retirement, most of the people we talk to 3 to 5 years out from retirement, you really start kind of getting that anxiety that changing your lifestyle brings, not really changing your cost of living or your lifestyle that you live, but just that you don't have to go to work every day. When that starts to creep up, it sort of changes people's way of thinking, rightfully so. And they tend to want to think about income at that point when they have to have their accounts and things they've saved for. They have to have those kind of producing income for themselves. And so there's a couple of ways that people think about that. The biggest thing I think that most people get probably hounded with when they get close to retirement are these annuities that will say, you got $500,000, we'll take that and pay you an income stream for life of X amount of dollars. You really, if you're entertaining that conversation, again, we talk always about products being sort of just a tool. A hammer can destroy something. It can also
Mhm.
build a house. So it's just a tool. But some of the factors to consider if you're looking at retirement in the next few years and you're hearing about annuities and guaranteed income and all this kind of stuff, what are the things that you're thinking about when you're approaching that decision or when you're trying to make a decision around that?
Yeah, I mean, we're very transparent about our view on annuities and their role in portfolios. I think they are a great tool to be used as an alternative to a certificate of deposit, as an alternative for someone that has has built their savings and has operated their life and has a low cost of living around um, uh, not having volatility or exposure to volatility. And so, in those circumstances, the right type of annuity that is extremely no or low cost, no commission, um, reasonable caps, because essentially, really, what I guess what we'll address here very briefly is the two different types of annuities that are sold to people most of the time, and that's a fixed index annuity and that's a variable annuity. Um, 99.999% of those are sold with commissions that are very high. you're talking about between 8 to 10%. So you kind of understand why there's symposiums and hotel conferences and
Steak dinners.
Michelin star dinners that are done for this. Well, because you know if the broker closes 5 million in annuities, he's walking away with 500 grand commission. So that's why he loves it, talks about it, and I guarantee you his money is not in it. So when you strip out the commission and the riders that go along to it, they're a tool to be used. For instance, a no surrender, a no commission, ultra low fee variable annuity is great as a complement to 401k and IRA assets if you have funds that are growing in a tax deferred way. A fixed index annuity is great for that money that would have went into a CD, right? And that kind of fills that gap. It can be a great tool for that. But as they're generally sold, it's a one size fits all. This is the best deal ever, and you end up with long surrender periods, very high cost, and an illiquid nature to the money. So yeah, you're exactly right. The hammer can be used to break something down or build something. It's all dependent upon how it's used. What we generally aren't drawn to is annuities for the sake of income. Because if you get a fixed payment that is unchanging, even Social Security has a cost of living adjustment. So if you get a fixed payment that's unchanging from an annuity and you're having that 2% inflation, or God forbid, let's say it even runs higher. Let's say they just really go to town printing money and it runs at 4%. Well, that 5 grand is only going to be able to buy you around 3 grand worth of stuff in a decade. Because the payment doesn't change. So you don't want to use that tool for that project or that income need. You want to use that tool for something different. And so you just have to be cautious when you're doing it, because whether it's at 2 or 4 or 1, you got to remember those fixed income blocks that don't adjust. Um, it's not that golden goose ain't gonna look very golden. It's going to start to have some tarnish to it in 20 to 30 years. But again, that's not to say there are appropriate aspects. And years ago, especially if you think back, because I know that just from our years of interacting with investors, there 15, 20 years ago, there was not the ability to do what we do for clients now really widespread. It was generally something that was reserved for, very, very high balance accounts. And so a lot of times annuities kind of filled that gap to kind of check the boxes. And it was not something that you could easily replicate with an investment advisor. And so you'd go to a broker and get that. And that's fine. And if that's the case for somebody listening, that may have been the best fit for you. But just as things change and as the cost trend of these products have really gotten low, gotten down to almost zero, you really just want to be very tactical in how you decide to use the product in your portfolio, if at all. Because again, I love them for when there's no commission, when it's ultra or no cost, and it's there to fill that money market certificate of deposit gap for money that you are already going to lock up 5, 6, or 7 years. But you maybe want to get maybe double or triple what the CD is paying you, but you're not doing it for an income rider or a death benefit rider and those types of things, because that's where you get into these problems where you get a fixed block of payments that's not going to adjust with inflation like the S&P or the NASDAQ naturally will over that trajectory adjust and then beat inflation. So if you charted this out and you looked at a fixed payment, assuming a 2% interest rate, and you see the purchasing power go down, and then you take on that same chart and you say, well, let's look at an S&P equal weight or a basket of balanced portfolio, and you'll see this divergence that'll grow and the gap gets huge 10, 15, 20 years out. So yeah, it's touchy. We're not salespeople, so we don't get to use the big, like everything is bad and everything is good type approach, which is sometimes easy, and sometimes it's easier than explaining the nuances and the subtlety. And because sometimes they're good, sometimes they're bad, right? That's not as sexy and doesn't really get you the sales. But
Well, you can also
I
build.
just
You can also sort of build
yeah,
whatever you want from it. So that's sort of it's kind of a cost benefit analysis. where you can have maybe inflation riders on some of these products that will add inflation riders or adjustments to your income. But again, it comes with a cost. So you have to kind of do the
Yeah.
math and figure out does it make sense? Or to your point, can you replicate that strategy somewhere else for a cheaper, you know,
Yeah.
cheaper cost and potentially less of lockup, less time commitment. So can you do it
Yeah.
in a brokerage account rather than a 10-year annuity? All those things
Yeah.
are worth taking into account when you're looking at it. So it's not across
Yeah.
the board. There's no wrong or right answer. It's just everybody has a different unique situation, and it's worth looking at in that light, no matter what
Yeah.
product you're looking at or what
Yeah. And I
solution
mean,
you're looking
again,
at.
the and who knows what the future holds, and who knows what type of creative changes, because we've seen such a lot. Just again, no cost annuities like that used to not exist 8 years ago. That did
Yep.
not exist, and they do now. And so it's always to be taken into consideration. Generally speaking, 90% of the time, it's for that conversation that put on here and sort of blowing right in my face. I may turn that off. It comes down to, hey, CD rates are dropping, and I got 200 grand. I'm not planning to touch it for 5 years. I don't want 2.5%. I don't want 3%. Okay, well, maybe we can get 6, 7, or 8, right? Maybe we can target that. Um, and it'd be a good idea for you. So those things exist. They're out there. We do them sometimes, but don't you when it comes to income, generally speaking, and again, I'm sure there's something out there that would prove this to not be 100% accurate, but the overwhelming majority of the time, you want income coming from growth assets.
Yep.
You want that to be the big driver long term. And we've seen people successfully navigate with a mixture, again, because years ago, 10, 15, 20 years ago, you didn't have a whole lot of options. And so we have seen portfolios where you may have 75% growth assets and 25% locked into income-based annuity. And it's a blended approach where they're taking a pension, Social Security, income from an annuity. And they have the majority especially over that period of time, their growth assets have, really just become very, very significant. But it's a good supplement. So you're right. Everything has to be taken case by case. But for education, for informational reasons, when you think income, it's always best mathematically to think towards growth assets. And when you think, what am I doing with my emergency fund? What am I doing with this inheritance? It's cash money. I already have investments. Maybe there's something that in 5 years I am going to use it. Maybe there's an argument that could be made. But even then, as time goes on, I'm starting to prefer index replication, tax sensitive investing, because you're cutting out the middleman and you're getting a more lower cost and more efficient return that really has better tax implications. But, things change, environments change, technology changes, and what we're able to do for clients just keeps getting better and better and better.
Yeah, I mean, the broader point to this whole planning room topic this week is retirement income planning isn't necessarily just about how much you have. It's really about how much that buys you, and it has to last the rest of your life, how much it buys you the rest of your life. So, in a week like this one where inflation surprises to the upside, it's a good time to kind of ask. If you have an advisor already, ask them about where your plan accounts for, does it account for this kind of situation? It's a conversation worth having. It's not trying to fear monger or anything like that. It's just a good conversation to have.
Yeah, yeah, and just again, think about that income. You want even Social Security, which is not the gold standard in retirement, right? Even it adjusts for inflation, because inflation's insidious, and uh, the most insidious aspect of it is when everyone forgets about it, and it's slow and it's low and it's small, but it chips away every year. So, let's look real quick here at. Uh, I know we've already touched on you have to have a growth component, and for people that may not be 100%, and that's okay. You may need an element of fixed income, whether that's coming from your money market, whether that's coming from a properly set up annuity, or whether that's coming from bonds. But you need to have a growth element and a portion of your portfolio invested in equities, particularly in companies that have pricing power and that can also raise prices when inflation rises and acts as a natural hedge over time. Dividend growth, in particular, has historically outpaced inflation over a long period of time. And I know there's a few other items out there that we talk with people about as well, that can be at least a settling of the mind of the threat of inflation in a retirement plan.
Yeah. Well said. Well, we'll wrap it up there. That is good returns for this week. We will be back in the studio next week with our full episode, NVIDIA earnings preview, and whatever the next chapter of the inflation story looks like. Either way, we're looking forward to it. But thanks for hanging out with us and spending some time.
Yeah, it was a great conversation. Hope everybody has a wonderful weekend. As always, if anything we talked about sparked curiosity, questions, reach out to us. Be more than happy to have a wonderful conversation with you. Take care.
Absolutely. We'll see you guys next week. Bye-bye.